The Bank of Japan's retreat from a decade-long radical stimulus is pressuring the government to rethink the way it funds its big spending packages with additional debt, a challenge made more daunting by political demands for permanent tax breaks. Prime Minister Shigeru Ishiba's administration plans to spend 13.9 trillion yen, $92 billion, for a package of steps to cushion the blow from rising living costs, which will be funded by this year's supplementary budget to be finalized on Friday. Ishiba's ruling coalition is also seen swallowing opposition party demands for permanent tax breaks, which analysts say may slash next year's tax revenues by up to 4 trillion yen. Such steps would come in the wake of the BOJ's exit from ultra-low interest rates, which increases the cost of funding Japan's 1,100 trillion yen debt pile, the biggest among advanced nations and nearly double the size of its economy. Contrary to other advanced nations that had phased out pandemic-mode stimulus, Japan continues to compile big spending packages, thanks in part to still low interest rates. But Japan can no longer rely on the BOJ to keep borrowing costs low as it ditched its yield cap in March, laid out a plan to taper bond purchases, and signaled its resolve to keep hiking short-term rates from the current 0.25%. Japan is expected to spend 27 trillion yen, or 24% of this year's total budget, on debt servicing costs. While the 10-year bond yield is well below the 2.1% the ministry used to craft this year's budget, the cost could balloon if bond yields spike. There is no sign the prospects of higher rates is leading to fiscal restraint. Total Japanese government bonds (JGB) issuance for the current fiscal year ending in March, estimated at 182 trillion yen, is down 6% from last year but may increase due to Shiba's spending package. Analysts expect total bond issuance for next fiscal year to remain largely unchanged from this year's, or increase depending on the size of tax breaks under negotiation among politicians. As the BOJ's heavy buying crushed yields, private banks now hold just 14% of the JGB market, down from 41% before the introduction of Kuroda's stimulus in 2013. Tighter capital regulation has also made banks wary of ramping up bond buying.